last lesson, we spoke about the forex market. Now, before we go on with our introductions, I'd like to take a breather and talk about forex pairs, because understanding them is important for the rest of our course. When trading forex, currencies are abbreviated into three-letter symbols. For example, the euro is the EUR, the US dollar is the USD, the Japanese yen is the JPY, and the UK pound is the GBP, and so on. These currencies are generally split into two categories, the majors and the minors. As you'd guess, the majors are the currencies of the US, Japan, UK, Eurozone, Canada, Australia, Switzerland, and New Zealand. They are by far the most frequently traded and make up around 90% of the forex market. The Russian ruble and Chinese yuan aren't included because their markets aren't accessible. The Chinese government actually restricts trading of its currency and manipulates it to an annoying extreme. Minor or exotic currencies are those of less prominent or emerging economies such as the Hong Kong dollar, Mexican peso, Swedish krona, and so on. They're traded in smaller quantities compared to the majors, and the cost of trading them is much higher. Now, when we invest in forex, we invest in the relative value of two currencies. Let's say the euro and the dollar. We'll call this pair the EUR-USD based on the respective abbreviations. The first named currency is the base currency, which is equal to the unit we're trading. In this case, 1 unit of euro-dollar equals 1 euro. The second named currency, the US dollar in this pair, is the counter currency. That's the currency we're trading 1 euro for. In this case, based on the current market, you'll be getting $1.20 for each euro. Hence, we say that the value of the euro-dollar pair is equal to 1.2000. We usually specify that value to 4 points after the decimal point, since momentary fluctuations in exchange rates are really quite small. Due to those really small sizes and the high liquidity in the forex market, most brokers will leverage their clients' investment. What this means is that a trader only requires a small percentage of the overall price to invest in a trading unit, a position. For example, if we have $250 to invest and leverage of 400 to 1, we could take a position of $100,000. As a result, those tiny movements in the price of a currency pair will have greater weight. That will lead to greater gains or losses on smaller investments. Due to the high level of leverage, it's possible to open accounts with a forex broker from as low as $100. This gives traders the opportunity to invest in markets which would normally be out of their reach. So that's it. Units of forex trading at your disposal.